This is Brian Putt. Today I'd like to talk to you about analyzing the U.S. stock market on a monthly basis. I'm not sure if this is a video about the analysis that I did, or if this is a video on how to use simulation to do the analysis. In either case, I hope you get some benefit from it. Let's start with the bottom line. What did I learn through the analysis? So what I did was to take data from 1993 to present and looked at the SPY stock data with dividends. And I analyzed the range of monthly changes by month, January through December, the top right graph over here. So what I learned was May is a good time to invest as the returns in that month go down over here. So if you had money to invest, you'd not want to invest it when the market is down. Also, if May is down, the chances of June being higher than normal is very good. That's shown down here. So the blue line here represents when the May return is below 0, so it's a negative return in the month. Then the return in June is shown here in the blue with an average of 1.69% increase during June. However, if May was an up month, then the return is 0.8%. So half the return when May is down. Some other observations looking at the top graph here. May and August are down months, consistent with the hypothesis that the summer months are a swoon month. The market tends to go down in the summer, maybe because traders have taken a vacation. And then in September, when they return, people start to trade again and the market rises. So over here we can see September is much higher, both on the expected value, P90 up here, and the P10. And then in November, over here, people are selling for tax losses. So the recommendation would be to sell your tax losses here in September. You can always reinvest them again in the November-December timeframe. And finally, if you're adding to an IRA or a Roth, put it in early. Invest in January. The market tends to rise in both February and March. So having looked at the results that I found from this analysis, let's go over and look at the model. So this is the model. Here's the objective. Traditionally, we think that the stock market drops during the summer. And I wanted to ask, is that really true? We've learned that it is. And then secondly, I wanted to ask the question, if May is a down month, what is the distribution returns for June compared to if all the data for June is included? So these are the observations which we already talked about. This particular model only has one random variable, and that's this one right here. And what am I doing? I am resampling the SPY data. SPY data is being over here. So from 1993 to present, on a monthly basis, I've captured the monthly return with dividends. So this is the monthly return in the month of January 1993. And what I'm sampling here is really this number here, 1, 2, 317, actually 316, because the last month here I don't have final data. I don't have the June data. So once I've sampled that, so in this case I've sampled the 66th month in my data set, I can say that that date in this particular case represents June 20, 1998. It also represents the month of June. And in that particular month, it went down 1.04%. With this one random variable now, I can reference it 12 different times, making reference to the current month. So in this particular month, if the month is equal to, in this case, January or 1, then I want to take this result. Otherwise, I'm going to give it a dash. Down here, same thing, but now I'm referencing February, month 2. So now I've got these distributions. I can then calculate the expected values, the P10s, 90s, and the standard deviations. But there's a trick here I've used. So I'm going to actually replicate this random variable again for you. So the first thing I'm going to do is come up here to SIPmath, and I'm going to clear that random variable. Okay? So it's now taking that out. By the way, I did 10,000 simulations in this model. So now let's generate this particular random variable again. First of all, I've got to get rid of this, and I'm going to put a 0. And I will now define it again, define it as an output with the name of January. Now it's important that I have numbers in here initially. So now what I'm going to do, I'm going to graph it. I'll show you what the graph looks like here. So what I really want is I want to get rid of all these zeros. I'm going to do that coming over here and changing this 0 and making it a non-numeric number. So I'm going to put quote underscore quote. And now my model is back. But you can see here's the distribution. Let's see, let's come down here and see what's going on. Oh, it lost the reference here for the January. So what we could do here is we can take this graphic, copy this up here, and then paste. And now I've got the new January, and now I simply need to select my data and delete this data set, remove that one. Okay? So now we're good. All right, so that's the model. Pretty simple. One random variable, and I'm able to calculate all this stuff. For the conditional distributions, what I've done here, you simply said, if the month is equal to 5, and it was less than 0, so it had a negative return during the month, then I'm going to go get the return in the month of June. And I'm only going to pick up those data points, otherwise I'm going to get this dashed line. And so that gives me this chart here. And for when May is up, I simply change this to when May is up, I'll go get June. That's all there is to it. But it's really interesting to use one random variable and then reference it 12 different times and then condition it. And that allows me to get the P90 and the P10 and the expected value by month for the US stock market. If you'd like a copy of the model, please contact me at brian@theputz.com. If you're interested in learning more about SIPmath, you can go to www.probabilitymanagement.org, and you can download the SIPmath toolbar over here at Tools. You can download either the PC version or the Mac version. Thank you very much.